Most traders spend years trying to figure out when to enter into the market. They study entries, they study indicators, they study risk management, but very few spend enough time trying to figure out when not to enter into the market. And ironically, that might be the skill that they need to save their accounts from either being blown or from them losing their hard-earned money. Over time, I've learned that trading isn't just about finding the right opportunity and the right setup to enter into the market, but also to avoid the situations where the odds are no longer in your favor. Today, I want to share some of the moments where I deliberately stay away from the market. I just strap my hands over my shoulders or wear a straight jacket just to prevent myself from clicking any buy or sell buttons. The first moment where I prevent myself from entering into a trade is when price is in the middle of nowhere. One of the easiest ways to lose money is trading when price isn't really offering anything. There is no key level, you can't spot that perfect order block, you can't spot the supply and demand zones that you always mark up on your charts. Like, there is no reasons for the buyers to either push the market upward or the sellers to push the market downwards. Price is simply floating over a certain range. For example, there is this chart over here that I've drawn where price is just making a series of higher highs and higher lows, higher highs and higher lows and higher highs, like that. And then when price comes to a swing high, you expect it to pull back to go and get some fuel over at this demand zone over here so that it can continue with that bullish trend. But for a retail trader who doesn't have patience to wait for the market to come all the way to his or her point of interest, they end up entering into the market, let's say at this point over here. Like, when price is in the middle of nowhere, you can't tell if price is either going upwards or downwards, because when you come at this point, price has not yet taken out this low that you've got here, so we can't confirm that the market is switching to go bearish. And again, at this point over here, we can't say that price is moving upwards because it has not yet mitigated our point of interest, which is this demand zone that we've got at this point. So any person who has some itchy fingers or something, they tend to enter into the market at this point because they've seen like this big bearish candlestick at this point, and when they see it, they enter into the market and they place their stop loss at this point, and then their take profit should be, let's say, at this point. As you can see, the risk to reward ratio is very minimal, like 1:1, because they entered at this point when price is in the middle of nowhere. Like, you can't predict where the market is going at this point. You can't say whether it's going upwards or downwards. Now, this is when price is in the middle of nowhere. So if you are a professional trader, you have to wait for price to come and mitigate this demand zone so that maybe you can enter at this point. You can look for longs over here. Let's say when price comes all the way to this point, let's say you saw price mitigate your demand zone at this point, it came all the way here. You have to wait price to come up, then come down, mitigate this small demand zone that you've got at this point so that you can enter into a long trade. So the trader who entered into a long trade at this point, they can aim all the way up here and then place their stop loss, let's say at this small candlestick that push the market to go up. And as you can see, they got a perfect risk to reward ratio, which is like 1:11.79. Okay, even if they say they have to aim at this point, as you can see, they are still getting 1:5.3 risk to reward ratio. So that means they've entered at the correct point. But the person who entered for a sell at this point, like when price is in the middle of nowhere, they don't get this perfect risk to reward ratio that a trader should be aiming for. Many traders see movement and assume that there is an opportunity. Let's say, for example, the person who saw this candlestick, let's say there is a big bearish candlestick at this point, they saw that momentum and they assumed that that is a perfect opportunity for them to enter into the market. But momentum itself alone isn't enough. And if I can't clearly explain why I'm entering into the market, then I probably shouldn't have entered into the market in the first place. The second moment where I prevent myself from entering into the market is when price is choppy. Not every market is trending. Sometimes price moves up and down without direction. For example, this chart that I've drawn over here, as you can see, price is not moving anywhere. Price is just ranging over this point over here. It's neither moving upwards, it's not creating this bullish trend, neither it is creating this bearish trend. Like it's just moving or hovering around a certain point. The market doesn't have direction at this point. Like at one moment, price can just create this very big bearish candlestick, and then you think that price is going upwards, that price is bullish, and then the next minute you see price creating this very big bearish candlestick. You think again price is moving downwards. This is why most traders get chopped in the market. A lot of losses occur not because they are wrong, but because they are trading a market that isn't worth trading. So for example, for somebody who is looking for shorts, they might look for shorts at this point because they think that the market is going downwards. They might enter at this point, they place their stop loss over here, and then they place their take profit all the way down here. And then when price reaches at this point, it reverses and goes and hits their stop loss again. And then they start wondering, why has price reversed on me? They think that the market is being unfair to them and all. But that is not the reason. The reason is because they entered into a market that is not worth trading. Like the market does not have this identifiable bias. You can't identify whether the market is going upwards or downwards. And if I can't identify a clear bias, then I don't force one. Now, this is the second moment where I prevent myself from entering into the market, when the market is choppy. The third scenario where I prevent myself from entering into the market is before and after high impact news. Now, this is where experience has really humbled me and taught me more than enough. Before major events, price often becomes unpredictable. Like you can't predict whether the market is going upwards or downwards. After the release, like volatility always explodes. Like price just happens to go upwards and downwards at the same time. Like it just chops your stop loss and all, like a jiu-jitsu warrior. And then you start wondering, what is price doing? Like price just becomes violent and moves in both directions before it actually chooses where it wants to go. Yeah. At that point, I'm no longer trading my analysis. Like I'm just gambling the headlines, and that's not my edge. For example, in this trade over here, we can see like price is just making this bullish trend. As you can see over here, it's making a series of higher highs and higher lows. And then at this point, when price reaches at this point, let's say it's 2:59 p.m. East African time. Like news always comes around 3 p.m. Yeah, there. So around 2:59 p.m. I decide to enter into a short trade. And then I place my stop loss at this point. And then I place my take profit all the way down here at that point. But most of the time, traders always place their stop loss alone, because the time that they have to place that trade is usually minimal, and one really has to place their trade really swiftly and all, so they just get the time to place their stop loss or something. Yeah. And then another trader predicts that the market will go upwards, and then they enter for a long trade at this point. And then their stop loss should come, let's say somewhere down here. And then at 3 p.m. exactly, like Kevin Walsh just comes and says good afternoon, or in the past Jerome Powell just comes and said good evening. And then at that point, price just drops all the way down here. It hits the stop losses of those people who entered for a long at this point. And then at the same time, after price reaches all the way down here, it just reverses and hits the stop loss for those people who entered for shorts at this point. So as you can see, price manipulated both sellers and buyers. Like both of their stops have been hunted, because for the person who entered for a short at this point, their stop loss have been hit at this point. For those people who entered for a long at this point, their stop losses have been hit at this point. Like during high impact news, manipulation is always key to the big boys, you know, the big investors, the hedge funds, the big banks, the big institutions like the smart money. They always tend to manipulate the retail traders to enter for the sales and buys during the high impact news, and then it just comes and chops their stop losses like a jiu-jitsu warrior. Like it just comes down and up, you know. I think you know what I'm saying. Yeah. So what am I trying to say? Do not enter into the market before, let's say just that moment before the high impact news occurs, or after, because that will just be you sending yourself to a suicide mission, like you're just giving your money to charity into the market. The next moment that makes me have this gut feeling or intuition not to enter into the market is during a losing streak. So a short story, over here we've got a trader. So he tells himself that the market is going downward, so he ends up entering for a short trade at this point. But all of a sudden, price just reverses on him and hits his stop loss at this point. Yeah, and then he tells himself, okay, my trading bias is correct, it's just that I entered at the wrong time. So probably this is just a liquidity sweep for price to gain more fuel to go downward. So he tells himself, okay, I'm going to enter for another short trade after the liquidity sweep. So he enters for another trade at this point, and again, boom, price goes upwards and hits his stop loss. He's not yet convinced. He enters for another short trade at this point, and then unfortunately price just comes down over here, and then it reverses on him and hits his stop loss. So that is when he tries to see that the market is in a bullish trend, and then he sits down and tells himself, okay, I've been doing this thing wrong. Why can't I just look for a long trade? Because as I can see, the market is just going in this bullish trend. So he enters for a long trade at this point. But the moment he enters for this long trade at this point is when price just goes down in his earlier direction and hits his stop loss. And then he starts telling himself that the market is kind of unfair to him and all. And then he tries to figure out for another place to enter into the market. That is where he's going wrong. During a losing streak. During a losing streak, after a series of losses, something changes psychologically in your mind. Like the goal quietly shifts. You are no longer trying to execute your plan, but trying to trade what you think the market is doing. You are trying to recover your money. You are trying to revenge trade so that you can come back to break even or something. You are trying to look for setups that are not even there. You are trying to trade emotionally. Like you start trading emotionally because you are very afraid that you are going to blow your account. Whenever I notice that happening, I step away from the trade, and me stepping away from the trade is the trade itself, because trading is not about executing a buy or sell order, but trading is all about doing what the market is telling you. So if I end up not taking a trade during a losing streak, I'm trading because I'm following my plan. My plan is, I'm in a losing streak, I cannot continue losing money. So what I can do is just take a break, close the book, and then later on, you can come back when your mind is fresh, and then you take a clear trade when you are in a right state of mind. Yeah. So if you're still watching, and before I go to the next point, I'm kind of curious. I want you guys to go down in the comment section and tell me which of these points that I've mentioned up there has really cost you most money. Like for example, me trading before and after high impact news has really swallowed a lot of my money. Yeah, so just go down and type the mistake that you did that has really cost you a lot of money. And if you can't see any of the mistakes right here, you can just wait, because I've saved the best for last. Then later on you can give me a feedback whether I've mentioned your mistake or not. Yeah. So the fifth restriction of me not taking a trade is when I'm not in my right state of mind. Sometimes life can be a little bit tough for us Forex traders. Maybe you might have gone through a relationship breakup or something. You might have lost a loved one, or maybe you might have had a very stressful day, or maybe you are just tired. And the market does not care if you're tired. The market does not care if you are stressed. The market does not care if you've had a difficult day. The market does not care if you've broken up with your girlfriend or your boyfriend. The market does not care if you've gone through a divorce. And the market does not care if you've lost a loved one. But all in all, your decision making does. Your decision care about your mental state. Like some days you are just physically present in the market, but all in all, your mind is very, very far away from the market itself. And those are often the most expensive trading days. Like whenever your mind is very far away from the market, but you're just there physically present. And so I've learned that protecting my mental state is also protecting my capital. What am I trying to say? Do not trade when you've gone through a breakup. Do not trade when you've gone through a divorce. Do not trade when you've had a difficult day. Do not trade when you are tired. Do not trade when you've lost a loved one and all. So just protect your mental state, and in the process of protecting your mental state, then you'll have protected your capital. Just remember that whenever you run out of chips, then you run out of trades. You can't trade no more. So just don't trade when you are not in your right state of mind. The sixth point, Mondays and Fridays. Now this ain't a hard rule. This is more of a theory than a law. And whenever you get a theory, that means that there are some exceptions. Yeah. But over the few years, I've learned that Mondays are not the most suitable days to be trading in. Like the market lacks direction. It's just trying to find the direction in which it will be going to over the week. Yeah. So for example, over here, let's say this is on Friday, we had a bullish trend and all, and then when price came over here, it needed maybe to retrace and come maybe to some sort of demand zone that we got down here so that we can continue with the trend. But over the weekend, maybe US clashed with some Asian countries and all, and whenever you get the clashing, that means that there are some impactful news over the weekend. And impactful news means that we are going to have a very great gap over the weekend. Yeah, so the market opens on Monday. At this point, we've got this very big gap, and then the market tries to retrace. Maybe it's just trying to find its direction over the week. Maybe it doesn't know if it'll have to retrace all the way down here, or maybe it will continue with the bullish trend and all. And right now, the smart money is just trying to settle in for the week. They're just trying to open their books to try and figure out the fundamentals and the technicals, and that means the market does not have a clear direction. It will just be chopping around, low volume and low liquidity. What I'm just trying to say is that the market is still finding its footing after the weekend. So that means Mondays are not the best days to be trading in, because you'll just be trading a choppy market. The liquidity in the market will not be so high, and that will risk your capital from being washed away. But as I've said, this is just a theory, not a law. So that means if you want, you can trade on Monday. If you see your setup, don't hesitate. Just by all means get into the trade and use a right risk management, because risk management is key. And on Fridays, this is the day when the smart money is just packing their bags, closing their books for the weekend and all. And maybe we've got some impactful news, because most of the news like the CPI or something always come on Friday. And that means the market will be choppy. Like as I've said, do not trade before and after high impactful news. And again, on Fridays, this is when swing traders will be closing their position so that they can settle in for the weekend, so that they won't be charged for the swap fees and all. So that means when they get out of the trades, that means that the liquidity will be low. If they were in a buy trade, that means sellers will be winning. And if they were in a sell trade, that means buyers will be winning. So Fridays again are not the suitable days for me to be trading in. But that does not mean that opportunities will not always occur on Friday or on Monday. So if you see your setup, by all means go in. There is nothing that will prevent you from entering into the market. But for me, Mondays and Fridays, it's a no-go zone. The seventh point, December. December is a month I approach carefully. Like liquidity often decreases during December. Many institutions are reducing their activity. The smart money is going for the holidays, Christmas, Thanksgiving, New Year and all. Price movement just becomes unusual and less reliable. The market isn't necessarily broken, but it's just behaving differently. Like there is just low volume of traders in the market. The liquidity is low. And when these conditions change, the traders need to adapt. Like whenever you see this low liquidity, then you must always adapt to the market and get out of the market. Like during December, just stay out. Go and spend time with your family, like you've been trading for the last 11 months. So for God's sake, just get out of the market and go do other things. This is the time when you should be spending time with your family, your friends and all, Thanksgiving, and preparing for the next year. For example, let me take you to this chart. As you can see over here, this is the start of November, and as you can see, the price action was so good. Like over November, the liquidity in the market was so high, the volume of traders was so high. They were just trying to collect their finishing touches over the year, trying to collect the profits, some profits to enjoy with their family over December and all. So that means the liquidity was so high. But when it came into December, as you can see, the price action was more of doji candlesticks and all. We don't get like this engulfing burst and all. We just get the dojis, like the price is just moving slowly and all. We are not getting this sufficient momentum into the market. And again, when the new year came, now this is when price decided to catch up with the momentum, and then this is when it went up. Yeah, but as you can see, the price action in December was not that good. So that means December is not a good month to be trading in. Yeah, so you should be adapting to the changes that the market tell you during December. So December, it's you and your family time. Yeah, this brings us to the last point that I'm going to give you of when not to trade. This is the last trading day of the month. Now this is another period that deserves caution. Large institutions are often adjusting their portfolios. Funds are rebalancing positions, flows are distorted, like the normal behavior of the market is distorted over the last trading day of the month. What appears to be like a technical move may have been just a trap, or the institutions trying to do housekeeping and all. Like the last trading day of the month is like a spring cleaning of the market. Yeah, and that's not something that most retail traders can predict. So what I advise you to do is, during the last trading day of the month, let's say for example right now we are in June. In June, don't trade on the 30th of June, because this is the last trading day of the month, and the smart man is just trying to do some housekeeping. They're trying to sweep the markets, and also that they can prepare or give room for the next month. Yeah, or maybe if it's May, don't trade during the 31st. Yeah, this is one of the biggest lessons that I've learned from trading. Discipline isn't about pulling the trigger, it's more of the ability not to. Most people think that success comes from taking action. Trading showed me that success often comes from restraint. The days when you talk yourself not to do anything, that is when success calls you. The market is open almost each and every day, except the weekends, but the opportunities are not. Patience is what separates the professional traders from the amateur traders. The best traders that I've been observing are not constantly trading. Like they can just stay away from the market for days without trading, just because they have self-control over the market. They are constantly waiting. So when should you be trading? You should be trading only when the market, your strategy, and your mindset all align. Not because you're bored, or not because you are emotional, or maybe just you want to get into the market impulsively or something. The goal isn't to trade each and every day. The goal is to make good decisions that will help you compound your profits more than your losses. And sometimes the best decision you'll ever make the whole week is deciding not to trade at all. Okay, thank you guys for watching. Don't forget to subscribe, like, and comment your opinion of what you think about this video. So for now, it's ciao ciao. Let's meet in the next video, and never forget that it's never too late. Do something with your life. Bye bye.